So, good morning, everybody. Final morning of the Process Mining Summer School. I think you all had a really great evening yesterday. Some are still recovering from it, I see. And I think you also noticed the object that is at fault for being a bottleneck for us making it here on time every morning. It's two objects that go up and down. Today we have two application sessions. And the first session is presented to you by Mieke Jans, and it's an honor to introduce her. Mieke has been working in the financial auditing industry before moving back to academia, and that means she has a wealth of knowledge of what all doesn't really work in financial auditing. And now I think it's simple to say your mission is just simply to make that better. So financial auditing is a very different use case than from the medical domain. I don't know how many of you are familiar with it, but I can tell you it is extremely fascinating which demands financial auditing puts on process mining. So pay good attention. You're going to learn a lot also for other application areas. Mieke, I'm very curious to see what you're going to present.
So this works, apparently. Thank you, Dirk, for the nice introduction and the kind words. I'll try to live up to them. So good morning. I understand this is your last day of a very heavy, fully crowded week. So I am happy to share with you that this session will be a bit more lightweighted than like going into alignments and advanced process discovery sessions. So a warm-up, who am I? Because you have probably seen this picture on the information brochure, perhaps seen my name, but a little bit of background might be interesting for you. So I'm not going to put a number on that, but plenty of years ago, I was doing a PhD and I was in accounting. And I was trying to find my way out of that. I was like, okay, accounting is not going to work for me. So where can I find something that will work? And I stumbled into the topic of fraud detection, using data mining for fraud detection. I thought, well, this sounds better. I want to go in that direction. And by going into that direction, I stumbled into process mining. We're talking now 2000 and, so here are some numbers, 2005-ish. So no Celonis, whatever, no disco, only PROM and PROM import for the people. Well, Dirk might know, he's old enough. So I collaborated with a European bank. And I got the opportunity, I was part really, I did an internship, I was part of their forensics department for fraud detection. And I had like this golden ticket, like I'm from your forensics department. And really it felt like I was FBI. Every department that I was like, I need to have your data. You know, I was like a young PhD student. Like, yeah, you're not getting any data. I was like, yeah, but I'm from your forensics department. Oh, then we have to give you that data. So that was, in hindsight, that was a very nice position. I did not realize it at full at that moment, but that's where I got my first steps into searching my way into data in an SAP system, getting myself familiar with all these ugly tables. I learned like, oh, there is like Beleg, these German words, they mean something because I saw all these references in the German tables in SAP. And so that's how I got into contact with finding my way into data, trying to transform it into an event log, and then doing value-adding process mining exercises. After my PhD, I started working at Deloitte as manager and senior manager later, where I tried to bring this field of process mining, which was becoming a little bit more developed. There were already some commercial tools. At that moment, there was only one, Disco. And a lot of companies were trying to build their own tooling, including like Deloitte at that moment. They had their own tool because there was simply no commercial tool available. So that's what Dirk probably referred to. I noticed how hard it was to have like, okay, but we have this nice technology, and I think there's a lot of value in there for you as an auditor, but still it was very difficult to sell it. I bumped into all these blocks that prevented process mining to really go to the auditor. And later on, I went back to academia to continue research on that topic. So what is my plan for today, for you? I will first do a step back. So, as I said, very lightweighted. I'm going to move a bit away from process mining, just to give you a setting, like, what is auditing and what is financial reporting? Because I understand I have a mixed audience here, and it is important to have that basic understanding. And then later on, I will obviously incorporate the process mining angle into that. Okay? So yeah, I just put all the logos that were kind of relevant in a separate slide. So I'm part of the Business Informatics Research Group. You saw my colleague yesterday, I think, Niels Martin, at Hasselt University. I'm also appointed at Maastricht University, where I'm part of the Accounting and Information Management Group. Again, to cross that bridge between accounting researchers and information systems researchers. Audit Analytics with a View, it's a nice logo made by my PhD student here in front, Shamir Pradhan. So that's a research unit that we're trying to organize our research on. And I'm closely collaborating still with another PhD student of mine, Manal Lagmouche, with Deloitte in Germany. Okay. I did not write this chapter in the book myself, although I'm here presenting on my own. I actually didn't inform my co-author, I now realize. Anyway, I invited Mark Eulerich to co-write this chapter with me. He's a full professor in internal auditing in Duisburg, Essen. So we had some conversations on how to position the book, also from the internal auditing perspective, because that was a part that I did not have as much expertise as he did. Okay, let's start working. Financial reporting. It isn't the job, I would say. I mean, it is a function of an organization to do some financial reporting. But no company is going to earn money by reporting its financials, its own financials. Okay? You can make a service out of it that you take care of the financial reporting of other companies, but at itself, it is not a core activity of any organization. So what is it? So we have organizations, they try to deliver value to a customer. That's what they do. We can talk about the motives, etc., why you want to add value, but in the end, you need to create customer value, otherwise you won't survive. So in order to do that, you need people, you need money. Most of all, money, knowledge, technology, but it almost all ends with money. So where do you get this money? You got it from banks who give you loans. You got it from investors. We say, well, I think this is a great idea. I think you will create value for someone and that someone is going to pay for you. So I think this will fly. I will give you some money. You give me some shares. And if you do well, my shares, they raise in value. So I can sell them if I want, or I can keep them. So this is a basic principle of how organizations actually do their, how they work or how they get their resources. So in order for these people, and I also put like regular people because it's also stakeholders, not only like, am I going to invest money in it, but do I want to be a customer in this of this company? Nowadays, certainly, there's more the questions of sustainability and green, etc. Do I really want to buy something here or don't I? So where do I get this information? How do I take this decision whether I want to invest in this company, whether I want to be a customer in this company or not? I need to find something. I need to have, in the end, some trust that I can collaborate with this company, either as a shareholder or as a stakeholder. So this trust is based on financial reports. So you ask actually a company, like, can you give me some documentation on the financial well-being of your organization? That's a financial side, and also some other aspects, like the sustainable things, etc. So here we go. This is what a company needs to do. It's not a core activity, but it needs to report on its situation. And there are some guidelines for that. So there are what we call GAAP, is abbreviation for generally accepted accounting principles, how you report on your financial setting. And there are different sources, standard setting bodies. I put the international one, the IFRS standards. So these are literally international, so globally followed. You have also US specific, but also country specific. Yeah? So most of these standard setting bodies, they impose companies to once a year create the following financial statements: an income sheet, a balance sheet, a cash flow statement. Not every country makes it mandatory. For example, Belgian GAAP doesn't require a cash flow statement. Yeah? So income statement, put short, is your revenue and your costs. So did you make a profit or did you make a loss last year? Your balance sheet is what do you have in your company? Literally, which assets do you own? Which buildings do you have? Which cars do you have? Your car fleet, everything, your assets. But also your liabilities and your own capital. So how did you pay for those assets? Did you borrow some money? So who are you owing money to? Or did you put in some own money? Yeah. And cash flow, I think that speaks for itself. Which cash got in, which cash got out. So in order for us to have trust to put money in that company, well, I need to know that those financial statements are a true and fair view. And they must reflect reality. So how can a company make sure that this is the case? So they do some things on their own to make sure that the financial statements that are generated once a year, that they are representing a true and a fair view of the reality. How do they do so? Well, they run their businesses, and as you know, a company is run actually through organization of their processes. So they have a bunch of processes in their organization, and every process, results in transactions, so things change in the organization, and this needs to be captured in the financial statements in the end. So take the example of a purchase. You have a bunch of activities, which I'm not going to go in detail because I'm sure you have had plenty of those examples this week. In the end, when you have purchased something, well, your company has increased assets. There is this additional laptop or this additional car. So you need to store this, like book the increase in assets, and you will keep track of that. And at the same time, there is this activity pay invoice. Well, at that moment, you receive invoice first. Well, your liabilities increase. You owe money to someone. And at the moment you pay it, that liability has gone. So while conducting your processes in your organization, you have to keep track of the financial impact because it each time impacts your picture of your financial state of your organization. So by organizing your processes, you also have to do like a shadow accounting or keeping track of these business transactions, what the financial implications are. Okay. So this is a visual representation of your organization. You have all these different processes. In the end, you book your financial impact, and it's those bookings that you will put in the financial statements in the end. Okay? Those financial statements need to comply with a number of characteristics. And these are like terms out of these standards from accounting. Yeah, your data needs to be accurate, complete, timeliness, integrity. I see you nodding, so people from the field will definitely recognize this terminology. So in order to get there as a company, because I'm taking like the assumption that we have like honest companies, in order to have financial statements that meet these criteria, what they do is, well, they need to make sure that those processes are under control. That's the key thing. That's how they will organize themselves. So if I get a question like, can we apply process mining on financial accounting? People without any background knowledge often think of having all these bookings in the financial accounting. Let me go back. They are mostly thinking about all these things. So the transactions in the general ledger, in the financial accounting, and they are thinking, can we do process mining on those transactions? My answer is, well, you could do so. I'm not going to say you can't. I'm sure you can find some insights, but I think you're not addressing the core thing, which is you want to know whether this is under control, and not like I have this whole series of steps which are relevant for my organization to create value for my customer. And in the end, I just make like a note, like, okay, by doing all these steps, the financial situation of my company has changed, so I'm going to report that. My assets increased, my liability increased. So only focusing on this aspect wouldn't do the job, in my opinion. Please feel free to disagree. So that's how an organization organizes itself to create these financial statements that are giving a true and a fair view. So that's where the internal control comes into play, and it has a puppet. It's the internal auditor. Yeah? So this puppet will be in my slides. It's the internal auditor, the purple one, whose main responsibility is like, I need to make sure that the processes in my company are under control, both for efficiency reasons as for risk reasons. So to mitigate risk. Yeah. Okay, so the audit. The puppet is internal, the internal auditor. Yeah. Well, if you go to a bank and you say, well, I have these nice procedures, I can show you. We have a very good and very experienced internal auditor, and that person makes sure that all our processes are under control, so you can rely that our financial statements that we prepare once a year, they are perfectly fine. Well, the bank is going to wants to have more assurance in that. And they say, well, nice that you already have an internal auditor, but I want to have someone independent from your organization to also have a look at your books. And that's where the external auditor comes into play. So that's where you have the International Auditing and Assurance Standards Boards is like, again, one of those standard setting bodies. So we had standard setting bodies for how to do financial reporting, and you have standard setting boards on how to run an audit, conduct an audit, to check whether those financial reports are according the principles. The job of the external auditor is to check that true and fair view with reasonable assurance. You can't expect an auditor to find and identify intentionally hidden fraud. There needs to be a reasonable assurance, the auditor needs to have a reasonable assurance that based on the investigations that he or she did, that the financial statements do reflect reality and represent its true and fair view. In these standards, there is one element of interest, which is particularly relevant for process mining. Namely, there is this standard 315, and that standard makes the connection between a risk-based audit, so you're not going to just take a sample based on nothing. So you're first going to assess where most risks are in your organization. Then you will do your audit. And in order to do so, it states literally that you have to obtain an understanding of the entity and its environment, including the entity's internal control. So this statement literally says the external auditor should have a look at what the internal auditor already did and should understand what this organization is, what's the environment and how it is organized. And this is actually what makes the call for doing process mining analysis. It literally is there in the standard, like you should understand the environment and the internal controls. So, we have this setting, we had already that internal control, but now let's have a look at the external auditor. I have a new puppet for the external auditor. The external auditor is actually concerned with the financial statements. In the beginning, he or she also went into only those financial statements, took all this, the general ledger, took some pages out of it and did some walkthrough testing. But more efficiently, instead of going directly to the financial statements, they will have a look at the internal control instead. But as you know, the internal control, there was already a puppet who worked on the internal control for a full year. I mean, this internal auditor is full year in that company, working full time on having a view on how this organization is in control or not. The external auditor just comes once a year for a couple of weeks at most and needs to form this opinion whether the financial statements are representing true and fair view. So what will he do? Well, he will love the internal auditor because, well, that person already did a lot of his job. Okay? So this is really the interplay between the external and the internal auditor. The internal auditor will really look at these processes. Are they in control? How is my organization organized? Does it make sense that we first create a purchase order, that someone approves it, and that we only then place an order? Well, from an efficiency point of view, it might be a bit faster if you immediately place the order and in parallel ask for some approval. But there is also the risk mitigation aspect. So in order to mitigate risks, well, let's keep that following order that we first ask approval before we order something. So the internal auditor is really on the process, and the external auditor will have take a little bit overlap, not looking into the efficiency aspect, but only, okay, what's the financial impact, and does it result in financial statements that are true and fair view? Okay, enough about this interplay. Let's go into how is an audit conducted. We start with the internal. The external is quite similar. And then I will tie this immediately to process mining steps. I think this went too quick. Nah. I don't know why the others are there, so. As I just said, this is the balance that the internal auditor always needs to keep in mind. I have an example. I did a process mining analysis with an internal auditor as my project sponsor. And we found out that a purchase order was on average approved 8 times. 8 times. Can you imagine? Think about that number. So you're working in a company, you create an order, a purchase order, like, hi boss, I want to order a new laptop. And there were on average 8 approvals. So the external auditor was, oh great, this is quite safe. And the internal auditor was, what the hell, what are my people doing? They shouldn't, approve all the time some orders. So this doesn't make any sense. I think that's a very nice anecdotal example of the difference between the responsibilities of the internal and the external auditor. The external auditor was really perfectly fine. Whoa, 8 approvals, that's good. Okay, but let's go back to the steps. It's better on this slide, I see. So the first step for an internal auditing is to plan the audit, and that's over a couple of years. So not for this year's only, just to have your planning. When will I investigate which process? And obviously, we can use process discovery algorithms for this. This is a very naive setting. It is naive in the sense that it assumes that you can just go for every process, you fetch the relevant data out of your system, you have one press on a button and you have an event log for all these processes, and then you do a quick process discovery analysis and you see okay, this one is spaghetti-like and this is structure-like. and I can decide based on that. So you already hear there are a lot of assumptions there because you cannot quickly fetch the data and then you have your results. But in theory, that's where we aim for. So what's important if we would be able to have this information? So if we could say, well, these are the core processes in my organization, and from each core process I can extract an event log, and I quickly feed it into one of the process mining tools, and I have these type of information. What's important to base your decision then on which process to mine first or to audit first is that you have some measures of structuredness. You have some measures of, okay, you can look at the picture, that's one thing, but it's much more, also much more objective to have some numbers. And you could have a look, for example, how many variants are there per 100 cases. But even then, if I have 20 variants, and it's nicely distributed, like every variant has 5 cases, or there's like one variant covering already 80 cases, and then the other 19 are for the other remaining 20 cases. That's a completely different setting. So even when I say you need to have some measures of structuredness, it sounds very straightforward, but if you zoom in, it's not even that straightforward. So you also need to have a look at the distribution, for example. Okay, so this is an example of metrics or measures that you could have a look at to base your decision on. After you have planned the audit schedule, like in this year we will focus on process A, next year will be process B, etc. Well, then you're going to plan the process audit, so of one specific process. We're going to investigate the procure to pay, order to cash, fixed assets, whatever, HR. And then obviously you will do a process discovery, and then you will do some conformance checking. And I like to split up here that you do conformance checking compared to a procedural model. So like with a BPMN or whatever, so a procedural model as compared to a declarative model. It will, I don't know whether I have some here. It can, for example, give you an output like this. This is from my early paper. This is a result, by the way, of my PhD. So where you see I had in this data set was 980 variants, but I could already see like the top 6 variants were covering 86%. So like a very quick overview that you could see, like, okay, I take the top 80% or whatever, look at the variants and check, just compare them and discuss with the domain expert, like, does this make sense? And I compare them. I see, for example, the first variant is nicely according to the model. The second variant, suddenly this change line in between, which was not an activity that was included in the process model. But it's okay. There can be a change line and then continue with sign, release, invoice received, goods received, that's IR and GR, and payment. Then I have like create PO, change line, okay, we can change a line. And then we have release. So there was no sign. So what happens is, in that company, there were 2 level approvals. Sign was the first level, release was the second level. And when discussing this with the domain expert, they said, well, it's okay, you can sometimes skip sign. There are just some conditions. So the value needs to be lower than, I don't remember, 200 or something like that. And then it is okay. So there were some explanations that these variants could be okay. But could also be not, but it was not like worrisome, like, oh, we should never see this. So at this stage, this is interesting to have a look at which variants are there. So do like a rough conformance checking to understand what you want to go and zoom into. For example, here, I see like, okay, but this happens quite a lot. 9% of my cases are following this variant, skipping a sign, which is apparently fine if the value is lower than X. Well, this is something that you want to take along in your audit and going to check that. So conducting the audit, that's where I where we move into what we would call in accounting, in auditing, test of details as well. There you're going to move from the conformance checking against a procedural model. You're probably moving into declarative checking. You're going to test a set of business rules that you identified in the phase before. So the example are the cases without a goods receipt, another variant that I could have seen before. Are those cases indeed related to services? Because it's not a problem if there is no goods receipt document when we're talking about a painting job that needed to be done or something like that. Okay, but we need to test that. And that's what you do in this next step. You're going to take one step deeper. So you already feel that now you're engaging a lot with the auditor. It's not like I can run these things, like I put a start and it goes through all these activities. It really needs to have this interaction between, okay, here is the event log, I see these and these variants, what is worrisome and what's not. And the downside is if you just do conformance checking at a high level, you will have like, okay, all these cases are not according to the model. And here are a few that are according to the model. And that's reality. And that's really annoying for auditing. And why is that reality? Because in the financial reporting, you can have a lot of deviations from your normative model. Because that's just a way how the companies are organized. I mean, how they operate. If you organize 100 laptops, they deliver you 80 and then they deliver you 20. That's a completely different trace that you will generate at the back end than when they will deliver you 80 and then 20, but they decided to make it one invoice and before it were 2 invoices. So from a business perspective, this is all similar. You received 100 laptops and there was like 80 and 20. From a business perspective, no difference. But if you start looking at it from an auditing perspective in the financial reporting, it's a different trace. So this is what makes it very annoying, because you will have all these different variants and it will first show up as all alarms and alerts. And then when you look closer to it, everything's actually fine. And that's what makes the transition of using process mining into auditing very troublesome. Well, yeah, then you have communicating the result is one of the phases. Well, I think it's quite obvious if you have this visual support of nice process models. It's also what I noticed when I had to present my reports to organizations. From the moment I show a process map, it's very confronting, and then it starts and it triggers a lot of discussions, which I also learned the hard way that it's not where you want to go. You want to keep them focused on the the results that you wanted to discuss about, and not like, oh, can you zoom into this and can you zoom into that, and do like standard analysis on the spot. Okay, so this was for the internal auditor, but then the external auditor comes along with this big love for the internal auditor because that person already did so much of his job. So the external audit process is quite similar. I'm not going to go into the same level of detail, but just to give you also the terminology and how the external audit is structured according to the standards, because that is very important. The external auditor needs to comply with the standards that are there. Yeah. And these standards, they talk about risk assessment phase and planning the audit. And they talk about test of controls and test of details, and then communicating the results. Well, before I continue on how to apply process mining in this, I like to share one of the difficulties that I struggle most with if I'm discussing this with auditors, with standard setters. So they have this test of controls used to be, you have to understand these standards date from way back. Test of controls, the principle is that the auditor comes into an organization and is going to evaluate the internal control measures that the organization have implemented and check whether those measures make sense. Like, is there at a certain moment of time an approval given by someone who owns the budget? Yeah. is there some kind of a segregation of duty installed so that not one person can both create an order and approve its own request? Yeah. So the external auditor comes in the organization and has to judge whether these control measures that the organization installed, whether those control measures are making sense, whether they are sufficient to mitigate risks. And so the internal and the external auditor has a bunch of lists in their head and on sheets. So they have to make sure, like, are the proper controls installed, and are they also decently implemented? So they will do some tests, some walkthroughs, and check whether those controls are really also functioning and not only on paper. The test of, so that's test of controls. Test of details is when they literally go into the details of some transactions. And they will zoom in and will take, for example, one particular purchase. Let's stick to that example. And they will check whether all the steps have been followed and all the control measures that they just in the test of controls have seen at a high level and have formed an opinion whether they are appropriate or not, whether they are also actually executed on this specific transaction. So they go into detail. Now, when we want to use process mining, I always compared it with, instead of, well, I'm very visual, so I'm going to take you with my example of the sheep. You have sheep in the garden, in the lands, and only the painted ones that have like died by the farmer, they are allowed to go through a gate. Okay, so internal control is a functioning of the gates. Only the dyed ones are allowed to go through the gate. All the ones without some paint on their fur, how is it called? They are not allowed to go through the gate. Okay, that's the internal control, is a functioning of the gate. The auditor typically comes and checks, like looking at one sheep, checks whether it is dyed or not, or whether it is allowed to go through the gate, and check whether if it tries to push one which is not allowed to go through the gate, try to push it through, and if the gate opens, well, there's a malfunctioning in the internal control because the gate opened, while the sheep was not allowed to go to that other land. Well, with process mining, you're not going to focus at those gates. You're going to focus at all the sheep that went through those gates. You're going to take a picture of all the sheep in the different land. And you're going to take a picture and you're going to see that most of them have indeed some dyed color on their wool. And then you find some of them who don't have this color. And so that's your evidence that the gates did not work properly. It's maybe a very weird analogy, but that's how my brain works, sorry. So I always see things very visual. And with this different setting, that with data analysis, not only process mining, but with data analysis, you're going to focus on what has passed the gates. Actually, you cannot talk anymore about this segregation of test of controls and test of details. It is an amalgamation of both. So this is what makes it a bit tricky when you're applying process mining in an official auditing context, because the auditor is still expected to report on his activities or her activities in this context. We did this for testing controls, we did this for test of details. Yeah? And another thing is that if they find all these exceptions, they have to explain what they did with them. They can't say, well, this is the downside if you do full population testing. You get a lot of anomalies, probably most of them are fine. And before we didn't even see them. And so that's the annoying thing. Then the auditor still needs to explain how did they deal with all these alarming cases. So risk assessment, same. So you do some process discovery and procedural conformance checking. Test of controls is where you're going to check, literally you know the control, so you're going to test these rules, so this declarative conformance checking. Test of details is more related to zooming into specific variants, take an example, follow that. And the visual support is the same. Okay, so if you put the external and the internal audit together, both can use process mining analysis. And it's mostly during that conduct the audit. So different phases can can use a bit of process mining parts, but it's mostly really during the conduct of the audit, the core, that you will use process mining. So the other parts can rely on it as well, but the core is really in conducting that audit. So since the emphasis of process mining in conducting an audit is in that internal control testing, I'd like to present a generic procedure. So that is like, I've sketched like a process of internal control testing, just like in a regular BPMN. And then I will go through it like, where are the question marks? Because, well, I didn't tell you with my plan, but the plan is to show you a lot of challenges and difficulties where we still have to, well, develop a lot of answers on how to bring process mining to auditing. So the first part is you understand your normative process, okay, and then you collect transaction data from the information system. Well, and there we go already. You had, I could not follow it online, but I'm quite sure it must have been very interesting of talk of Dirk. Also Jochen normally touched on this. So you cannot simply say like, okay, there is event log. You do not have one case notion, so that's a big of a hustle. So I always compare this, and this is like, so the event log building, as I call it, in the traditional way. So I'm making abstraction of all the solutions that Dirk probably talked about with the knowledge graphs and changing perspective. But in the traditional way, as where we are standing now with research, in applying it in a real-life context, you have to pick your choice. I always compare it with taking like one picture of a very nice setting. So if you're in Barcelona, you want to visualize Sagrada Familia, and you are only allowed to take one picture. Which picture is the best? You cannot say which is the best. It depends. What do you want to capture? Do you want to capture like the nice, like forest-like insights, the colors that you have insights which you would not expect if you look at it from the outside? Or would you like to have all these details at the outside? So you can't say this is the best picture. It all depends on what you want to see, and choosing is also losing. And that is the same with building your event log in the traditional way. You have to pick your choice. For example, I want to follow a purchase order at the item line level, and then I will build my event log with that as a case notion, and I will have one picture. And if the auditor then wants to answer specific questions, which I cannot answer because I have taken that process notion, I would need to take a different picture, read. You need to pay me enough man days so that I can create a different event log with a different case notion. And scripts are now already out there, and it was not the time when I was working at Deloitte. Then it was literally like, okay, I need to start writing a new script, so it takes me so many days. Now, SAP, Oracle, you can reuse the same data structures and scripts from other companies, but nevertheless, there is still additional effort to take the new picture. So that is a huge challenge, which we are working on. I say we because I'm also working with Marco Montali on this topic. I'm looking forward, by the way, also to have a closer look at the knowledge graphs later. I did some research on this in an auditing context to have an idea whether this makes a difference. Whether it makes a difference, what the auditor decides. Because nowadays, if an auditor wants to apply process mining in an audit, they typically hire someone with a more technical background who knows what process mining is and who knows how to build an event log, which is mostly not an auditor. So that person can, well, he or she takes design choices, and it can, for instance, say, well, I take an invoice and I trace it back to all the preceding documents, and then I have my picture. But that person could also have chosen for taking one of the original documents and then follow it chronologically through the process. It has a different picture. So what I think is extremely important to investigate is whether the choice of which picture you take has an impact on the audit quality. Will the auditor come to different results, a different risk assessment, when they build the event log one way versus building the event log at the other way? So that was one of the key open questions which I think are very relevant to investigate further. So yes? Mm-hmm. No, no, I know. I am not sure yet. I have tried something in between back at the time. I thought I called it like a dynamic process notion. I just let it move along. So if there was a purchase order, my case notion was a purchase order. If there was no purchase order, I just took the first next document that was available. So my object was actually moving. It was a mess in communication, obviously, because you say in so many % of the cases, what is a case? Depends. So it doesn't work. So I would have to see how it would look like with object-centric, yeah, a log that is object-centric. So I don't. So if you are experiencing with with that, I'd be happy to be informed later. How nice. Ah, okay. Yes. Yes. Okay. Okay. So no answer yet. So hopefully there is an answer to follow later on. So the internal control testing, you first understand how things should go. That's your normative model. You extract data somehow out of the system that you can compare with the normative model. And the next step is then you identify deviations by comparing the real behavior, the observed behavior with the normative model. Well, another challenge, how do you present this normative model? So some preliminary investigations already here together with Hamza Ricci, Jan Mendling and Hajo Reyers was on what do you present best to an auditor? Do you present the auditor best with a process diagram or do you present the auditor best with a narrative? And we did not even check the business rules. So in every phase when we're talking about the normative process model, well, there is a question how to present this best. And so according to this study, we found out that depending on the task someone needs to do, well, a different representation is recommended. Yeah, so this is something that people do not really think about too quickly, but it is really important. Depending on what you do, you might need to have a different representation. So sometimes you will need to have a process model to understand it quickly, and sometimes you need to have like a written text, or in other situations, you might need to have like a set of rules, a list of rules. Yeah? So something to investigate further as well. And then, in the internal control testing, a lot revolves around identifying deviations. Sounds logic, okay? But then, let's make this operational. What is a deviation? What exactly, when are you talking about a deviation? Because as I just explained, you can have a nice procedure, but if someone has like partial deliveries, you get your 80 laptops now and 20 laptops later, and we make it one invoice, or we make it 2 invoices, or even 3. Well, all these things, are these deviations? yeah, from the theoretical point of view, yes. But so this is one of the big challenges. When are we talking about a deviation, and at which level do we want to see those deviations? Because as you have seen with the conformance checking tools, they look at the case level. How would you feel as an auditor? You're checking, like one of the main selling things of an auditor is we do full population testing. Yeah, we don't take like a sample of 25 invoices. No, we take full population testing. Great. So you have 100,000 of purchases to look at. Would you be happy with 100,000 times, well, here was an insert of this activity, and here was a skip of that activity? Yeah? So probably not. You would like to have it aggregated, so how do you aggregate it? At which level? And then very importantly, which type of deviations are we talking about? So I already mentioned like a skip and an insert, because that's the most, well, that's the most atomic level you have of a deviation. Something was inserted, something was skipped. And it was the start of a discussion with a former PhD student of mine. We wanted to write, not really an algorithm, but put it together so that it would make sense, that the output would make sense to the auditor. So we were going like, okay, if there is an activity missing, but it is put here, we just call it, it was pushed backward or something. And we just wanted to write it down. And if they switched places, it's a swap. And then I was like, yeah, but is it a swap? Isn't it just like this was pushed backward and that is pushed forward? When are we going to use which terminology? And we had so many discussions. That was actually the start of her research study, of her PhD study, to investigate which deviations do auditors see when they are confronted with process deviations. So we had a look at literature, and in the literature there was actually not that many papers that expressed deviation categories, but we found these. Some of it's really based on 3 or 4 papers only. So we renamed, so if the content was the same, we renamed it. So you just had skip, repeat, loop, insert, swap, and replace. These were the only categories we found from a control flow perspective. In the end, we did a study with the auditors, presenting them a bunch of deviating processes, process executions. And it turns out that the auditors don't use all these terminology. They really use 3, 4 at max deviation categories. So this is important when you want to transfer very interesting research from one field into one application domain. You have to make sure that you speak the same language. So auditors are not talking about swap or replace. They do not make a distinction, a difference between a self loop and a repetition. It's just a repetition. It's more than once out there. So there's a different level of how they look at the process deviations. So that is very important to take that along if you want to continue both in practice or in research, if you want to investigate, pick up some of those challenges that I present, that you take this into account. So what is the what's the contribution of that type of that research? Is that we start with an event log and a process. We run a conformance checking algorithm, which will end up with a little set of transactions that are according to the model. Much more transactions that you could say, like, these are deviating from the process model. And at least now we can group them into categories that make sense to the auditor. And we say, hey, instead of like this transaction has a skip and an insert and this transaction, blah, blah. No, you can group them and say, well, here are so many deviations and they all have in common that they are missing an activity. And if you drill down, you can see which activity. They are missing a signature. They are missing a goods receipt. And then you can continue further. Oh, they're missing a goods receipt. Well, there might be a perfect explanation for that. It might be a service. Then it makes sense that there is no goods receipt. They're missing an approval. I don't like that. Actually, this should not take place. This has been a very malfunctioning of my gate. There are a lot of sheep without any dye on their wool. Okay, so this is what happens. You are confronted in the internal control, so I take it back at the higher level, which is just based on how an audit always have been executed, paper-based. They take an example, they see that they have a case that deviates from what was expected, they investigate it, and they say, well, okay, this is actually fine. Then we call it an exception. Or this is not fine at all. We have to investigate this a little bit further. Yeah. What we see here is, so this is what I just said, specify follow-up investigation. So if you take along the example of there has been no goods received, you say, well, there is a perfect logic explanation for that. Maybe it concerns services. So you specify a follow-up investigation. You say, well, let's take all these cases that have no goods received, and we're going to test whether these all concern services. That's what you do. So you take a subsample, you check that one specific rule, and then you can say again, you have some deviations or not, so that's where you have the loop back. Oh, wait. Yeah, so it is quite important. You see here what you use as an input, and I did not, but you use known risks. You use audit experience, yeah, domain knowledge. You use business rules, so you touch upon a bunch of concepts that are very familiar in process mining. The concept of domain expertise is a bit difficult. That's probably also what was part of Neil's talk yesterday with the healthcare, the domain expertise, to integrate that into process analysis. But business rules are actually your declarative process models. So the goal in the end is moving away from sampling, being able to identify all the deviations. And the idea that we're also working on currently is that we can integrate that domain knowledge of the auditor with a machine learning algorithm that combines these rules and makes the knowledge of the auditor explicit, so that we can classify all these deviations. Yeah, so classify all of them by as having either an exception or an anomaly. So the external auditor in the loop, we give a sample of deviations to the auditor. The auditor looks at it very closely with the orange glass, and it classifies them and says, well, this is an example of an exception. I know it deviates from the normative model, but this is an exception because it's a service. It's okay that there's no goods received. Or it's an anomaly because this can never take place. We should definitely look into this. We feed these labeled deviations to an algorithm, to a classifier, and the classifier learns this, is going to use this knowledge to classify the other deviations. Obviously, with the beginning sample, the start sample, the classifier won't have enough information, so the classifier will have cases that will be able to classify as anomaly or exception, or it says, I don't have enough information, I need more. And then we repeat this. Yeah. So that's the idea of the active learning concept in the auditor, so auditor in the loop, for classifying the deviations. Okay. So here are all my question marks. So this is the big picture, the general idea, but there are so many things that still need to be investigated. Some of them block us from really fully implementing process mining and auditing. Some of them are not really blocking us, but would be nice to have a clear answer on. Like, for example, what is the impact of a representation? How do we represent the model? It doesn't block us if we now start with procedural models, and in the end it turned out that it is a bit more efficient that you use a declarative model. We can go along with what we have now, but it's good to know what the impact is. So the event log, that's like the major challenge that I'm also still I'm actually most interested in investigating further. The process representation, as I mentioned, these deviations, how to present the information to the auditors, how to set up this active learning. So how do we extract the knowledge out of the auditor? So when we present a deviation and the auditor gives us feedback, this is okay because, well, actually you're making the domain's knowledge explicit. And we're now investigating whether we can use rule mining algorithms that detect the information that the auditor is going to provide. So this is the study that we're conducting with Deloitte for the moment. And then, obviously, which algorithm. So, in sum, we have the organization. The organization generates a lot of data. The data can, well, if I'm a consultant, I say, well, you can easily create an event log out of this data. I'm not a consultant, so it's a lot of work to create a certain event log out of this data, which might allow you to answer some of your questions, but also not all of them, because you have taken one specific view, but at least it's a start. Based on that event log, which captures your real behavior, you can compare that with a normative process, procedural or declarative. Okay. Then you can do your regular audit, supported by some of the process mining aspects. So the external auditor will go along through all these phases, and they will collaborate with the internal auditor to build on these his or her findings. The major challenge is you do conformance checking. You get, like what we call in continuous auditing, a flood of alarms. How to deal with those alarms? So full population testing, yes. You can start from all the transactions, but then you have so many deviations. So a lot of auditing now resolve to sampling deviations. So yes, they do full population at the start, but somewhere along the way, they still reside to sampling because there is no solution yet for how to deal with all these deviations. So, but challenges are opportunities. So because it's my research agenda for the coming years, and my PhD students now need to know what to work on. So continuous auditing is a concept that you now hear more, I think, in audit practice. It's a concept that was already coined in 1991 by Miklos Vazareli. It just means that we have to, instead of moving from once a year running an auditor, that we continuously keep track of how the financial statements are evolving and whether everything is under control. I hear this term now coined more and more by consultants, but it is still, well, there are some practical challenges. But process mining is, in my opinion, a way that we can move towards continuous auditing. Multiple views on a single database, that's important. There is not like the ground truth and like starting from one database and giving it to one auditor, starting from the same database, giving it to another auditor, can lead to different results. This is important. And this is highly under-investigated, or I think because of what you mentioned, auditors see the value of using process mining, but do not have the people in-house to really grasp like the underlying technical details and the consequences of decisions. So this is highly investigated. I think most of the research, including my own, started from comparing observed reality, so the event log, with a procedural model. I think it's not making any sense. That's looking in hindsight. Because the audit DNA is like checking rules. They have all these lists with checkbox. So that's more in the DNA of an audit. And that relates to declarative mining. So I think it's much more interesting to move the research angle from conformance checking with procedural models towards conformance checking with declarative process models in the context of auditing. Well, And important to realize the last one, that audit-proof conformance checking is a research field at its own. It is not about just copy-pasting what has been developed in the computer science research stream and just saying, okay, now we can apply it in an auditing context. I think there are so many different settings, like the language that the auditors use, the fact that they're more familiar with checking rules than comparing to process models, because most of them that I talk, and they're very happy, like, oh, we also see the value of processes. We now draw flowcharts. For every client that we come, we investigate their process and we draw flowcharts. I'm like, wow, you're moving in the right direction, but please, there is a standard. Use at least BPMN. And they're like, what is that? Oh, BPMN, never heard of. So I'm now teaching my students that will become active at the job market, etc., that at least they know a decent process modeling standard. But nevertheless, checking rules is much more in the DNA of an auditor than using a process procedural model. So again, moving it to the audit context is not just copy-pasting the techniques, but also living, walking their shoes. So that was it. Please reach out if you are interested in this topic or want to have a chat about. Thank you for your attention.
Thank you very much for a nice presentation, Miki.
Thank you.
So I have a very basic question, actually. Do you think it's possible to generate these financial statements using event logs only, like by exploring the event logs?
I think it's important to first think, then answer. I think this is a chicken and egg problem, actually. Because they're at a different level. So the financial statements are already aggregated. They say like, okay, we have for so many €1,000, we owe some money to some suppliers. And obviously behind that number are a bunch of transactions. And the event log is at that level of transactions. Why I was thinking so long was because there used to be, and that's what yesterday I refreshed my memory on that. In 1969, there was a paper that mentioned the role of capturing events for accounting purposes. So we are now used to having double entry bookkeeping. And we aggregate information in the financial statements for the purpose that I just mentioned. Another option that was investigated in that paper of 69 was, instead of aggregating it for the purpose of what I explained, we can leave it disaggregated and store it at the event level. And literally the paper is event approach for accounting, it's with the same term. And so the idea was to create purpose-neutral, disaggregated event data, and then whomever is interested in that company should aggregate it the way he or she wants and do whatever they want. If we would have chosen for that approach, then this whole process mining and accounting would be a walk in the park, I think. And then your question would make perfectly sense. I mean, your suggestion that let's start from these events and then we can create our statements. But now I think, given the different way that accounting, that bookkeeping has gone, I don't think it's possible because of the different level. At a first thought, maybe I have a different thought later.
Thanks, Mika, for the presentation. Now you lead. I'm back here.
Hey.
You leave me slightly puzzled. I want to approach my internal audit department and say, look, we know a little bit about process mining. Don't you want to start? Would you do this or wouldn't you do this? Because I'm not so sure if I tell them to do research or actually apply it. So how would you frame this? Where does it make sense? Yeah, in a very practical sense, where should you say, let's go ahead with it and just apply it because it works? And maybe be careful when you expand it into certain areas.
Yeah. First of all, I would definitely apply it and learn along the way, and then just contact me, and then we can set up some studies on the side from that. I would definitely apply it, and for example, like the event log building, you start with what's out there now. You can have a look at the research like object-centric, etc., and check whether that's already feasible for you to apply it or not. What's most important, if I say, for example, the challenge of which picture you take, there's nothing, as long as you are aware of the things, I think that's the most important aspect. So there is no harm if you are aware of the choices that you take, and that's really the most important thing. So based on the decision that you take, I take a purchase order as a process instance. Now I know that I can have some duplicate, some artificial multiplication in my data. As long as you know that, you can just filter out. That's not a problem, but you have to know it. So I would definitely say go ahead, and just be very cautious about everything that you do, and then you will find also solutions. Yeah. That's good. Looking forward. Other questions?
Hi, I'm not sure it's about auditing, but I was thinking about the problem you described, trying to view from multiple perspectives to the problem.
Mm-hmm.
And I hear this all week, several topics are spoken about is object-centric process mining, for instance. But do you have any idea why we are not looking at the building of the event log? Because the event log still looks like a flat table to me,
Mm-hmm.
whereas there's techniques as multidimensional databases or whatever, or tables. Could that be the solution instead of trying to make an object-centric way of looking at it from this flat table and make it on the event log introduce already some dimensions and with that having more insights?
Mm-hmm.
I'm not sure whether
I
this
see
is...
Dirk already.
It's a bad idea, Dirk.
I'm happy to hear your thoughts as well.
So there's active research in auditing to actually use graph-based models for auditing that were kind of developed actually earlier than I came up with the idea of the event knowledge graph. So this predates it. The approach is slightly differently, more tailored towards the auditing perspective, but yeah, it's graph-based to kind of have a model the different assets that you have and the liabilities and the financial statements in a graph-based setting. So people are looking into this, but as I think I tried to show, the concept is nice. Industrializing it is hard. I mean, it took us 15 years to get event logs in industry a reality out of tables, and I think it's still challenging to do this also with other formats. How that changes auditing, I have no idea. So that's where my knowledge ends. So Nika can probably say more what that.
Well, if you're talking about change and auditing, that's just so. In any case, it goes slowly. I mean, you have to, yeah, relate to the known way of working. I would say, well, as long as we have the event log as we know it now as the input for the main process mining algorithms, then we have to, then we are stuck to that anyway. So that would be my first answer. I'm not sure whether you were referring to the financial process mining work of Michael Werner. Okay, so because I remember you also mentioned it for the chapter. Why didn't I include that as well? First, because of time limitations. That approach says, looks into the financial transactions only. So that what I said, like, I prefer to look at the complete process and see the financial reporting step as like, this is like, okay, this is the impact on our financials. So that work of Michael Werner goes into only the financial, so the journal postings in accounting. And instead of having one process notion, it just follows the references. So if you have one journal entry here and then there's another journal entry there and it refers to that, it ties that together. And if there's yet another one, it ties that together. So that's a double entry bookkeeping. The downside, the major downside I see of that approach is that you cannot construct one process model out of it. So the process model instances, because I read that paper several times to really grasp everything. I had a lot of discussions also with him. So the process model is really at the level of the process instance. So you, for every case that there is of 2 or 3 bookings, there is a process model. So I don't think that's very useful. You would literally give thousands of little graphs to the auditor. So. And I also know of EY Netherlands that they looked into that technique and that they say, well, no, we cannot use this. It's, yeah.
Hi, thank you for your presentation. My question is more regarding the business side, because I was wondering which person would be more interested in doing the auditing with process mining, because they will be more scrutinized, they will be more easy to detect the flaw. So the company likes it because they can say to the shareholders that they are more transparent, or they are trying to avoid to use process mining in their auditing.
Yeah, so the most interested project sponsor is mostly the process owner. So within a company, the one who's responsible for a process. The process owner, together with the internal auditor, are, in my experience, most interested, because it's their responsibility that the process runs smooth. That's the process owner's responsibility. The internal auditor wants to be in control. They also can use all the aspects of process mining, whereas the external auditor, and that's why I also said, like, he loves the internal auditor, the external auditor can only use parts of the process mining analysis for what he or she really needs to do. So I did run some process mining analysis for the external auditor, and I was always like, why are you paying so much for, I mean, I have to build this whole event log and run all these analysis, and I can give you all these insights, but they only need this. It was mostly like, can you run segregation of duties, for example, and put a number on it. So the external auditor, it isn't, at the moment, with this maturity level, seeing the efforts that you need to build the event log, et cetera, it's mostly not in balance the way, what it costs and what brings it to them. So mostly internal auditor and process owner.
So they wanted, the process owner finds it nice because the company will be more transparent. I mean, because by providing this information to the external auditor, he will be able to evaluate better because they scrutinize better the company.
Yeah, but if the external auditor is not familiar with process mining, they would not dare, and obviously they should not dare to trust on those results. So they first need to have process mining expertise themselves in order to understand which data was used, how the event log was built, what the downsides were of the design choices that were taken, and whether all these precautions have been taken also into the reporting. So the external auditor cannot just rely on what the internal auditor did without any background knowledge themselves. Okay. I hope that answers a bit your question.
Hi.
Hi.
Thank you for the presentation. I have a question from a practical research perspective. How did you approach the qualitative evaluations of your methods? How did you reach out to the auditors and collect your insights?
Yeah, that's literally just calling old former colleagues of mine and knowing like which persons are interested in this type of research. It's important to talk to partner level. Yeah, that's really just my network of people that I know and that I ask for favors. That's what it boils down to. I don't have money to give to them. They don't have money for PhD students for mine, so it's give and take what we can do.
And
I don't have a silver, how do you say that, a silver bullet for that?
like how many interviews would be necessary to form a good opinion that's worth writing about and sharing forward?
Yeah, well, that depends on your journal, but we can take that offline if you want.
Thank you.
There was one more question here of Antti.
Thank you very much for your presentation. At the very, close to the end, you mentioned a few things that kind of stuck with me for a moment. You mentioned that it's leaning heavily towards declarative approaches right now.
Yes, especially for you.
Yeah, yes, absolutely.
You're welcome.
Thank you. And also that kind of like the rule-based way of thinking is kind of natural for the auditors in a way. But this reminded me that there is quite a long line of research with Barbara Weber and many others who have looked into the understandability aspects of declarative and procedural models. And usually they tend to find that the procedural approach is either more easily understandable or at least similar to the declarative approach, but they really haven't found many cases where the declarative approach comes out on top. So now I'm wondering, does their observations and findings, do they carry over in the auditing domain as well, or is the auditing domain somehow different?
Mm-hmm. That is to find out.
Okay.
Simply, we have to find that out.
So this is open research?
Open research, yeah.
Okay, thank you.
Thank you.
I would add to this particular question, it just matters of what the people, the stakeholders in the domain, how they think. If you think declarative, then you're going to make people unhappy with a procedural model, and the other way around. And I think that's what we've seen in this kind of research. We've primarily been talking to people who think procedural, and then they say declarative is hard. Yeah, of course. yeah, indeed, research is needed.
Okay.
So thank you very much, Mieke, for this great overview of all the different challenges. It tied a lot of things together that we've seen over the week. We're now going to have a coffee break, and after that, Marlon Dumas is going to lead us to yet another very fascinating topic on task mining for robotic process automation. Thanks again, Mieke.
Thank you.